Thank you very much, Peter. And good morning, everyone. Thank you very much for joining us. So over the next 15 minutes, I'll be covering what Citi sees as some of the investment opportunities as well as the challenges in the economic landscape. As always, before we get started, just a general advice disclaimer. So all of the information we provide today is just going to be general in nature. If you do want to learn more, just reach out. We'll provide some of the contact details at the end of the presentation. So there's no doubt throughout the day you've been hearing some of the projections about what's going to happen within markets and the economy. I think one of the most important things today is I actually won't be providing an in-depth prediction, and that's because we all see how these predictions play out. We saw in 2021, that there's certainly a lot of challenges that present itself, and things do change. I guess the one thing I do want to highlight though is even for investors who want to be playing it safe, that doesn't necessarily mean keeping your money in cash, earning close to zero. And my name is Peter Moussa. Thanks for joining me. I'm one of the senior investment specialists at Citi. So one of the most dramatic events in our lifetime was no doubt COVID. The global economy literally went into a complete standstill. Everyone was forced into a compulsory lockdown. And one of the questions we often get is, especially in 2020, even though markets initially sold off quite abruptly back in March, they did have quite a sharp rebound shortly following that. And the reason for that is a couple of things. One is how quickly governments and central banks responded, both with monetary and fiscal policy, and they had to do that, right? So they had to issue stimulus to individuals that couldn't go to work, and what that did, in addition to things like the reduction of interest rates. So in the US, for example, that we saw a reduction of 150 basis points in interest rate cuts, is that actually creates a very stimulatory effect in terms of asset prices, not just equity markets, but across the board. We saw commodity prices start to rise, property prices as well. And a lot of that is a function of that additional liquidity from central banks. However, there are consequences to that. And the key consequence, of course, is inflation. And so what happened is, I guess one of the most dramatic things throughout the lockdowns is consumers couldn't spend on things like services because they were in lockdown. And so they started to spend more on consumer goods. And that today is leading to things like supply side issues and depletion of inventories, because ultimately what you had in that dynamic was an increase in the money supply, an increase in money circulating within the system, however, a reduction of both goods and services. And so when you've got more money chasing fewer goods, that's ultimately what leads to inflation, which is certainly a dynamic that we're experiencing at the moment. So that type of policy response, while was absolutely essential at the time, does have consequences which we are dealing with at the moment. One of the interesting things when we look forward into 2020, 2022, is, I guess, ultimately when we're seeing the very high inflation and growth prints that we're currently experiencing, we have to remember on a year-over-year basis, that's comparing it to a very low base from last year. If we fast forward into next year, those base effects are going to work in reverse. So when you're comparing inflation in Q4 next year to the very high prints that we're getting this year, again, the year-over-year rate of change is actually going to be smaller. And so the chart you can see on the left-hand side there is, you can see that even though over the next couple of quarters, we will continue to see these alarming inflation prints, ultimately that starts to come down in the second half of the year. Again, that's on a year-over-year basis. And it's an important distinction to make. So things like rents, for example, and wages, while they'll go up and likely stay at the elevated levels, they're not going to continuously go up at a very high rate of change. And that's ultimately what drives markets. And we'll cover that in a little bit more detail as well. One of the key themes that we're hearing about, whether it's in today's conference or in financial news, is the very alarming inflation levels. So ultimately, what investors really need to keep in mind is what already has been priced in. And we can see by looking at the chart on the left-hand side is what this is showing you is the US forward inflation swap structure. And it's looking forward in terms of what the inflation expectations are. You can see near term, the markets have already anticipated and priced in extremely high levels of inflation. And even just in the last month alone, so the light blue line relative to the dark blue line, you can see the dark blue line, which is the November forward swap structure. You can see very high levels of inflation are now already priced in through 22, and that starts to diminish as you go forward in time. Now, if we were to ask, what is it that caused the inflation in addition to more money chasing fewer goods? If you have a look at the supply side disruptions, ultimately that is caused by the change in spending behavior to goods when services weren't available. It's also because of the stimulus checks that have gone out. Now, the effect of those stimulus checks will diminish, and you're unlikely to get more and more stimulus while inflation is a political concern at the moment, especially in the US, but really all over the world. So really, inflation from a rate of change point of view is likely to be transitory, even though the absolute level of cost of goods is likely to remain elevated. Now, one of the other questions we often get is, are investors too late to join, the recovery story within equities and asset prices? And what this chart here is really showing is how long these recoveries typically last within equities. And so it could appear a little bit noisy, but ultimately what we're looking at here is previous recoveries from the 80s, the 90s, and so on. You can see the key down the bottom. The two key lines that we should be focusing on is the black line, which is the average of those, as well as the red line, which is where we are in the recovery at the moment. And you can see in terms of the duration of the recovery, that there's still time to go. But really, we're at the point of the recovery where we do need to be a lot more selective in terms of the sectors and style factors that we invest in. There's no doubt that as we've seen asset prices go up across the board, again, whether that's equities or whether that's property, you can see that as the price of the assets have gone up, yields have struggled to keep up with that. And so you've actually got quite an income dilemma at the moment. And so even if you're looking at property, equities, or even obviously things like term deposits, the returns on those assets have been lower and lower. And in the case of something like a term deposit, it's actually negative when you consider inflation, right? So if you've got a 3 to 4% inflation rate and you're only earning 1% on your term deposit, you're actually earning a negative real yield there. And so that creates a very interesting dynamic where investors really have to explore navigating quite an uncertain market, especially while interest rates are likely to remain low for longer than people expect. Now, one of the things, if we have a look at sources of income, there's two key asset classes that I wanted to have a look at today. The first is corporate bonds, and then the second one is what's called structured notes. But to start off with bonds, you've got things like, there's two key types of bonds: government bonds, corporate bonds. Now, government bonds, as we know, pay next to nothing while interest rates are low. And then you've got your investment grade bonds and your high yield bonds. At the moment, a lot of our clients are focused on your investment grade bonds. Now, for anyone who's unsure, bonds is really just another word for debt. You're essentially lending either a company or a government money, and that company or government pays you a fixed or a variable interest rate as a coupon payment. Now, one of the questions we often get when we speak to clients about bonds is the relationship that bonds have to interest rate changes. Now, we all know that interest rates are close to zero at the moment, and the most common question is, aren't interest rates likely to go up, and isn't that likely to have a negative impact on the bond prices? And that's absolutely true. Bonds do have an inverse relationship to interest rate changes. The most important thing for investors to remember, though, is what have markets already priced in terms of those rate hikes. Now, if we look at the forward rates market, you can see that markets have actually already priced in 3 interest rate rises for 2022. Now, in our opinion, that's quite aggressive. We're expecting actually no rate rises both in the US and Australia for next year. You may get 1 interest rate, but with markets pricing in 3 rate hikes, that's actually extremely aggressive. And central banks, the commentary from central banks tends to match our view. And so what that could mean is, as you get an unwinding of those interest rate hike expectations, that could actually push up bond prices, right? So if markets have priced in 3 rate hikes, but they only get 1 or 0, for example, then the bonds potentially have the capacity to increase in value. Now, we are being very selective with which bonds we're putting into portfolios. We are focused predominantly on short duration bonds that typically have a lower sensitivity to interest rates. So there is still a tactical place for bonds within portfolios. And the reason we do add bonds to a portfolio, in addition to that interest rate dynamic really that I described, is because they have a very different volatility and risk profile relative to something like shares. And so what you can see on your screen here is we're looking at Westpac as a security, but we're looking at Westpac across 3 key different asset classes. That's bonds, hybrids, and shares. And you can see your investment grade bonds, which is the dark blue line, is a lot less in volatility, a lot lower in volatility relative to something like equities or hybrids. The hybrids are your listed bonds, but they're very different to the investment grade bonds that we focus on. And you can see even during periods of stress, whether that's the COVID crisis or the Royal Commission, especially your shorter duration bonds, they typically have a lot lower volatility, and therefore they do have a place in portfolios, especially when interest rate expectations are potentially overdone. So your bonds, there's a number of different names. In fact, we've got over 1,000 different bonds we can talk to clients about. The returns vary between 2.8, you can see on your screen here, all the way up to 5%. And again, if you're interested in learning a little bit more about this and how they trade on the secondary market and how liquid they are and everything else, please let us know and we can certainly talk to you more about that. So while there are Australian names, you can also look to diversify outside of Australia. You've got international names, things like McDonald's, for example, US companies issuing bonds in Australian dollars. So you don't necessarily have to take currency risk either when you're looking to diversify. Now, the second and final part of the presentation is focusing on structured investments. So these are equity-linked investments, but they also have a downside hedge to sort of remove some of that downside volatility and uncertainty. All of the equity-linked investments go through a very rigorous research process. We lean on both our global economists and analysts that focus within the different sectors and help us identify the different opportunities. Now, the way the structured investments work is, let's take one of the live examples that we have at the moment, which is FedEx, Amazon, and PayPal. These are all international US names, but you can choose to take the investment with a currency hedge. So you can see Australian dollar there pays you a fixed and unconditional coupon, in other words, 6.5%. Now you get that coupon with this structured investment, regardless what happens. Even if the dividends are cut to 0, you still receive that coupon. The investment can run for between 6 months and 2 years, and it offers you a downside hedge of 40%, which is observed at maturity. So let's see how that looks. So in this structure, you receive your coupon. The coupon is paid to you every quarter. And you can see that what this screen is showing you is, let's say the worst performing stock is down 20% on the maturity date. Because it's within that 40% downside hedge, you receive 100% of your capital back on maturity, plus the coupons, which have been paid to you every quarter. Now, the risk, of course, is you do get a dramatic decline. Now, this is rare, but of course it can happen. Now, if the worst performing share declines more than 40% on maturity, then what happens here is you receive 55% of your capital back plus your coupon. So your total return, you can see in the top right-hand corner, once you've taken the coupon into consideration, is a loss there of 31.4%. Now, there's a couple of different baskets we have available on any given month, usually between 5 to 10 different baskets, so you can diversify a portfolio with that downside hedge. Each basket would have different underlying stocks, different coupons, and a different downside hedge. You can see some of them have 45% allowable fall, and the others earn so the other one on the left-hand side has a 40%. And ultimately what these are designed to do is allow you to profit whether markets go up, whether they stay flat, or even if markets decline, as long as they don't decline by more than 40 or 45%, as you can see by that kick-in feature on your screen. So really the takeaway from today is, if you do want to be defensive, you don't necessarily have to stay in cash. You don't need to jump and be quite aggressive either and jump all the way into equities. You can look at things like bonds and structured products that really help reduce and mitigate some of the risks while generating an income for you. That's everything from me. If you are interested in finding out more, would love to set up a time with a relationship manager to go through this in a bit more detail. Feel free to reach out on the contact number you've got on your screen there. Thank you very much for joining us. We hope that's been informative, and we hope you enjoy the rest of the conference.